Markets are at a critical juncture. With earnings season underway and volatility elevated, we're entering a window where the next 100 S&P points could set the tone not just for the week, but the entire quarter. Investors are facing a rare moment where liquidity, sentiment, and fundamental risks are all converging. It's a time that calls for focus and a clear view of what's actually happening beneath the surface. Let's dive into it. All right, so let's jump straight to the charts. The S&P 500 futures down 53 points in the pre-market. A lot of things moving, including the dollar and gold, but let's just start with the markets. We're at actually a very critical moment on the S&P. First of all, let's go through some basic facts. The market persistently is making lower highs and lower lows. There's a primary downtrend below all the major moving averages. At this point, the entire rally, the bounce that we've seen was simply an oversold bounce that happened in 3 hours when we had that extraordinary one-day rise in the markets. And since then, the market's been very weak. This is a market that is still being distributed. This is a market that is in a primary downtrend. So what are the levels to watch? And so I'm going to break this down to a 4-hour chart. And I want to highlight a couple of key areas. First of all, when I draw on the Fibonacci's of this last rise that occurred, you can observe that around, let's call it 51 and a quarter on the downside is the 61.8 fib retrace. When we do this extension of this little flag for this morning's weakness, you can see that red zone overlaps into that fib area. We basically have a very easy 100-point drop that can happen and not actually change anything from where the market sits. And so going into today with us already down 50 points, it shouldn't be a shocker to members or any of our listeners that the market is down even 150 points at some point by the end of the day. That doesn't necessarily mean that the downside window is open, that the floodgate is open. We could easily see that this zigzags its way down into the zone and still manages, let's say, on some earnings beats, and maybe that disappointing news isn't going to be disappointing, and the market could rip higher to 55 to 5600 from that base. So we don't want to just assume that it's all downside. It's actually going to be an incredibly asymmetric moment in the market when we drop about 100 points, because at that stage you could pretty much go long the market with a very, very tight stop, not for a long-term buy and hold that we're talking our traders can do so, because you can stop yourself out very quickly if it's wrong. And if you're right, there's a big upside potential of a snapback of at least 300-400 S&P points. At the same time, if that level gives out, let's say we'll just make it a round number. If we have any drop below 5100, the downside window is open. And at that stage, retesting of the previous lows around 4850 and even a drop down toward 4500 on the downside would be the path of least resistance in this primary downtrend. Now, do I think that that has the highest probability right now? Well, I do believe that in order to get down there, we're going to have some bad news that is not tariff driven. And that's the key, because up till now, it's all about what Trump has been saying and the tariffs. I think that at this point, what we need is to see something that is indicating that the economy is suffering because of this. And that, again, is going to be a lot on what the corporate earnings guidance all say, and two, whether or not we have a jump in the unemployment rate using the SOM rule, indicating some form of a recession may be already upon us. If those kind of things happen, then 4,500 is 100% on the table. But there's no, I don't want to say that those are certainties. This is why that we're going to watch this incredibly closely. This week is important, but next week is a really important week. So the next two macro outlooks that I'll be sharing with all of you are going to be critical to sort of understanding how this is all playing out. Right now, the simple thing is, if we drop another 100 points, I'm going to tactically attempt to buy that with a very short stop. By no means is it a high conviction, bigger picture call that I'm making. It's simply a tactical trade there. Okay, so beyond that, I want to highlight we remain at a very highly elevated VIX level. Volatility remains in the 30s, 32. The daily implied ranges are over 100 S&P points still. So these kind of swings are just normal on that. The other point I want to make, we're going into the Mag 7 earnings with the stocks being incredibly weak. Now, this in itself could actually be bullish in a sense that these are things are so oversold and pricing so much negativity that it could be a scenario where how much of that is priced in. But there's no denying these are being actively distributed, and we're going to get Tesla and Google this week. And so watching their reactions will be actually a really big tell, some important information for us what to expect when we get to the four big ones coming out next week. All right, so the other thing to highlight is the Russell, the small caps, incredibly weak. And this is interesting because obviously Mag 7s have been the dominant part of the story. But you would think that if we were on the stage of recovery or this was a major buying opportunity, a turn point, the small caps could really march to the beat of their own drum and really gain some traction based on a turnaround of circumstances. And yet they're incredibly weak. The bounce was out borderline pathetic, and the primary trend is very distinctly down. I would view this very negatively toward the whole thing. And at the same time, I want to simply highlight when we go to some of those global equity, Nikkei down 450 points, but still just a rising wedge formation that could easily roll back down. Euro stock, a rising wedge formation that could easily roll down. And when you look at things like the stresses that are coming from the junk bond markets, while we have seen a bounce off the low, this is not an impressive situation to be in with corporate credit spreads widening the way they did. This is still all a very highly vulnerable moment in the S&P 500. Okay, so let's talk about some of the other key things. Number one, let's talk about the dollar. Dropping down now $1.14. We're down to the 98 handle down below. Just a nasty Asian overnight session in the currency markets. This has definitively, I'm going to put on a weekly chart. This has definitively broken all of the 2-year supports of 2023 and 24. There is no support line anymore. Now that doesn't mean we all have to panic because like if you're only chasing this move now, it's kind of late to react. Notice this measured move is pretty much done. And so at some juncture, anticipating some fib retracement back to like 100 to 102 would be still a very natural bounce. And point is that panicking and selling your US dollars now doesn't make a lot of sense. But if we see very negative price action in the weeks to come after such an oversold condition, if it, like, let's say, behaves like the Russell 2000 is, then I would get even that much more bearish because it means that the sell cycle is not over. Let's see how the bounce plays out here. Now, the knock-on effect is that this has influenced a whole number of currencies to start moving. First of all, even Bitcoin has upticked the first time above its 50-day moving average. Now, I do think that we could, let's say, see Bitcoin hit, let's say 92,000, the 50% retracement. It could easily move 5,000 more on the upside. But this has not been where the money's been going. The money has been in gold. And I don't think that that's imminently going to change, where suddenly Bitcoin is going to exponentially move faster than gold and catch up. I think that this will be a laggard. But though, at this point, if it closes above the 50-day and follows through, it rising toward the Fibonacci zone is a very natural thing to see, especially considering Bitcoin throughout this entire correction has held the Fibonacci retracement zones. And so there, I don't want to say anything bearish about Bitcoin other than it's not where the action is. So where is the action? gold. Gold's up $80 today, and this parabolic rise is just accelerating. We were talking about that if it was going to stall, it would stall at 3,300 or it's going parabolic. At this stage, 3,600 would not shock me. Even under the right circumstances, it could see even 4,000, because this is the part where we're going into parabolic stupid mode. When the slope of the rise is accelerating, like I'll just kind of draw it on this way, is where the upside moves happen all very quickly. The one thing I will say is that we should move a lot, and it should all happen very quick. In other words, wherever gold ends up going, odds are very good that in the month of April that we see the swing high of gold. And that could be at 4,000. But the point is, it's not going to take months for this trade to play out. This is literally happening real time right now. We could be up $100 every day, day after day, as this thing is inevitably ripping to where its ultimate short-term top is. At this stage, we're trailing protective hedges behind with puts and other things to lock this in. But staying long gold during this phase is really important. So let's see how much further and how much gas it has in the tank. Now, silver has been strong in this, but it's not like silver. I would treat silver a lot like Bitcoin, which is it's going to get the tailwind, it's going to go higher, but this is not where the action is. And so, like, could silver hit 34, $35? Yeah, but gold is where the real action is. So let's talk crude oil. We talked about what were all of the previous lows act as overhead resistance, and that's where we see like things like these Fibonacci zones lying. We could still get an impulse as high as 66, but this bounce, we have to fully expect it to fail. And oil very easily could find itself heading right back for a double bottom retest, if not making a lower low. If this ends up being simply a rising wedge formation like this, then you've got a downside target that's back down to $50. Even if it, point being here, weakness in oil is still the path of least resistance. I still am quite a strong bull when it comes to the broader commodities. And at some point, there's going to be really good money made in the oil markets. But this is a primary downtrend. It is being distributed, and there is zero sign of a bottom. So you have to respect the prevailing trend that's unfolding right now. And we got to look for where will the bottoming formations be and where will the bottoms come in. At this stage, it clearly is still very distributed and weak at this stage. All right. Very quickly, I think copper has room to roll right back down on the downside. I'm far more neutral here. It's not that I'm bearish. It's just I don't see copper ripping back above $5 and staying there in this environment. So expecting this thing to muddle under $5 in a trade range is far more likely at this stage. Uranium quietly might no. I don't want. I think this is a really attractive price. What I don't like is that there's zero accumulation at this point in uranium. It's like dead money. It's been forgotten. No one's touching it. And the thing is that something like that can stay at this great price for an extended period of time. And so I'm one of those people that thinks that this is not where you're going to have a lot of risk. There's a good thing to own at these prices, but you're probably going to be watching paint dry. It's going to be something that is going to stay stuck in this range, and it's going to be boring. And when I see that, it's like maybe I'd rather wait before engaging it at some point in the future. When it comes to the interest rate markets, I'm just going to focus on the December 2026 SOFR futures going out just over a year and a half, kind of as a guide for what I think potentially is going to happen. I still am in the camp that there's policy error going on at the Fed, and the Fed is staying way too tight, too long. It's going to trigger some form of a recession. It doesn't have to be a nasty one. It's some sort of a recession. And then the Fed will have to overcompensate on the other side. The market is simply not pricing this in. We could see these SOFR futures up at 97.5, 98 on the upside as interest rates maybe go down to even 2% or lower. Still think that there's an amazing opportunity because I just don't see the risk of this collapsing down to 96. Yet there's so much room for it to go higher. And so for me, it's a low risk, high reward, a trade-off of continuing to press SOFR futures on the upside. You can express that through 2-year treasury bonds, like something like the TUA, which is the simplify leveraged 2-year treasury units. This could easily be at 23, 24 on the upside in that kind of environment. The long bond, on the other hand, is much more of a muddle. In fact, it looks outright weak. And so to me, at this stage, you want to be very neutral to long bond and respecting that there's some sort of distribution here and press the short end of the curve, which is essentially one big steepener trade. And I think that is still a half decent way to play things. That's your macro outlook for Monday, April 21st. Have a good trading day, everyone.